$10,000 a month in rent coming in, whether you're at work, on holiday, or asleep, spending it on whatever you want. That's what most property investors dream of, and this is the 9-step blueprint that can get you there. But I have to warn you up front, it's so boring, it's almost insulting. No buy 20 properties in 2 years, no development, no flipping, just slow, steady property investing, the kind that Kiwis can actually do. So in this video, first, you'll learn how many properties you actually need to hit 10K a month. Then, once you learn the types of properties to look for, finally, you'll learn the 9 steps to make it all happen. And I've divided it up into 3 phases: plan, portfolio, and payoff. Now, phase 1 is the game plan, and it has 3 steps. And at the end of this phase, you're gonna know this number that either is gonna excite you or potentially scare you off. Now, step 1 of the plan is to set your goal. Now, most people say they want financial freedom. Now, that's cool, but what does that actually look like to you? Like, how much would you actually need to spend to quit your work for good and actually be happy? Now, for this video, we're saying $10,000 a month. That's $2,300 a week coming in. And more importantly, we want it to be passive, as in you fly to Rarotonga for 3 weeks and the money still lands in your bank account. You're not flipping properties, you're not getting calls from tenants at 11 p.m. because they locked themselves out of the house. The goal is that the money comes in and you're hands off. And if your goal is something different, like trading houses for capital gain or running short-term Airbnbs or growing a building company, that's cool. That's just a different strategy from what we're talking about in this video. Now, if you think you can live on less money, say $8,000 a month, that's fine. Change your goal. Then we move on to step 2. And step number 2 is to decide what properties you are going to buy. Now, in property, there are 2 main types. We've got growth properties. These are usually standalone houses or townhouses. These tend to go up in value faster, but the rental return usually isn't as strong. Then we get yield properties. These are often multi-income units, like a dual key apartment where it's one apartment, but you've got a studio on one side and another apartment on the other, so you rent it out to 2 sets of tenants. Or maybe it's some student accommodation, like this one in Hamilton that my team recommended to an investor. It's got 4 studio units plus a shared common area, and it's really close to the university. So you get 4 sets of tenants, which tends to bring in way more rent. Now, these don't go up in value as fast most of the time, but they do get a stronger rental return, and that's when investors move over towards yield, right? So here's why that matters. Because the higher the yield, the less money you need to retire however you want. So let's say you want to live on 50 grand a year. At a 5% yield, you only need $1 million worth of property. If you want 50 grand a year and are invested in properties that only get a 2.5% yield, well, it's half the yield, so you need twice as much money. You need $2 million in property in order to get that same income, which is why most investors I see go for growth when they are early in their investing journey. But once you want that cash flow coming in and to live off the rent, that's when you move across to the yield properties. So now we know that at this stage, yield properties are often the way that most investors go. We still need to figure out how many properties you would need to make that 10K a month, which is why step number 3 is to calculate how much money you actually need. We've got to do the maths of it. Now, my rule of thumb is that yield properties should get around a 4% net yield, which means that after you get the rent coming in, you pay all of the costs like your rates, maintenance, and insurance, you get a 4% rental return per year. Or if you divide that by 12, that's 0.33% per month. And that basically means that if you have a $1 million property that doesn't have a mortgage on it, that $1 million property would pay you $3,300 a month before tax. And the mortgage-free part is really important, because if you have a mortgage on your property, then the rent will start going towards the bank rather than paying you most of the time. So the way you figure out how many properties you need is you take your spending goal per month, in this case 10K, you divide that by 0.33%, and that gives you $3 million worth of property. Now that could be 3 $1 million properties, it could be 6 $500,000 multi-income units. It could also be one big $3 million block, if you could find one. The dollar figure and the yield is what matters, not the exact number of properties you need. Now, I can see your face. $3 million in retirement, that is a lot of money. But here's the thing. Firstly, you don't have to come up with $3 million today. You don't even need to save it. You build it over 20, 30 years using the other 6 steps that we're about to talk about. And as you're about to see, if you can make it happen, the income is often extremely stable. Companies cut dividends, term deposit rates go up and down, but tenants almost always pay the rent, and rents often go up and very rarely go down. And look, don't bother taking notes because you can download this 10K a month boring blueprint. It's got all of the tools, the maths, and every important part of the video in this cheat sheet. And when you grab it, you'll also get my new behind the screens video series. It's 10 emails and 5 videos that aren't really right for YouTube, but I literally share my screen and show you how to invest. They're closer to a phone call rather than a YouTube video. So click the link in the description or scan the QR code on your screen and I'll send you both. So now you know your number, $3 million in mortgage-free yield properties. Phase 2, portfolio, is all about how you actually get there. Now there's more than one way to make it happen. So step 4 is all about choosing your wealth building way. How are you gonna make that money? Let's say you sold a business for a few million. Maybe you just buy properties for cash. You're done, skip the rest of the video. I've seen it happen, but that doesn't apply to most of us. So you might decide to buy some properties and pay down the mortgages really fast. Once they're mortgage free, you live off the rent. You know, I was in a water taxi going around Stewart Island a few years ago, and the skipper started telling me about his investment properties. He'd bought 2 properties in Southland. They're cheaper than average, but he'd paid them off on a very normal income. Now he's living on the rent. He's probably not going to hit 10K a month, but that wasn't his goal. He's probably on track for about 5K a month. He was very happy with that. The strategy worked for him. So that's one legitimate path. But by far and away, what I see most investors do is the most boring option. It's just to buy growth properties and hold. Buy growth properties first, wait 10, 15, 20 years for them to go up in value, sell some, use the cash to buy yield properties and just live off the rent. It's boring, but it works. So that's what we'll focus on for the rest of the blueprint. Now at this point, the big question I get all the time is, Ed, I'm comfortable with property going up in value. I'm fine with taking out a mortgage, but how big of a portfolio can I actually build? And will it get me to 10K a month? Which is why step 5 is to plan your portfolio. Because the truth is, not everyone can buy 3 properties in 5 years. Maybe you can do it faster. Maybe some other people are going to do it much more slowly. Like if you're 50, your mortgage is nearly paid off, the kids have left home, and you're at your peak income, you might be able to buy a couple of properties straight away. But if you're 30 with 2 young kids, a big mortgage and 1 income, your plan looks different. You probably can't buy as many properties, and you might not be able to purchase for 2 years and then buy another one in, say, 5 years. And to try and help you understand what your situation looks like, I hired this Excel guru, Nick, who actually competed at the Excel World Championships in Las Vegas, to build a spreadsheet that helps you figure out how many properties you might be able to buy and when. You plug in your age, your income, your equity, and it creates a projection showing how many properties you could potentially buy and when. So in this example, a couple earning 80 grand each might be able to buy 3 investment properties in 8 years. Then if those properties grow at 5% a year, much slower than they have in the past, by year 20, they'd be sitting on a portfolio worth around $2.5 million. Now, there's a great argument to be had about whether 5% is the right number to use in your spreadsheet when you're thinking about how fast house prices might increase in New Zealand in the future. You might use a higher number, you might use a lower number. That's cool. Just change the number in the spreadsheet. Just choose the number you feel comfortable with. But the point is, when you see your numbers and how many properties you could potentially buy, that could get you excited and maybe think, okay, perhaps this is something I could actually do. And look, I originally gave the spreadsheet away on a webinar and I wasn't ever planning to do it again, but here we are. You can download it for free in the cheat sheet. The link's in the description or QR codes on your screen. And once you get a sense of how many properties you could potentially buy, step 6 is to actually go out and find the right properties. Right now, there are over 45,000 properties listed across New Zealand, so this is your needle in a haystack moment. Every property investor will have a different opinion on what a good growth property looks like, but here are the top 5 things that I look for. First, I want an undervalued area. That's an area where house prices haven't gone up as fast as the rest of the country, because that means there could be room for catch-up growth. So if I think about Christchurch 7 years ago, this is the classic example. House prices in Wellington were absolutely climbing, but Christchurch property values, they're very flat. People were wondering if Christchurch house prices were ever going to go up again. And that is exactly the point where I started investing in Christchurch, because I thought it was very undervalued. After the next 7 years, house prices took off massively. They massively outperformed Wellington and many of the other major cities in New Zealand. So I'm looking for an undervalued area. The second thing I want is suburbs in those cities where house prices have gone up in value faster in those suburbs. Now, you're smart enough to know that just because house prices in one suburb went up fast in the past, it doesn't mean that'll continue in the future. But if you can look at the areas where prices have taken off, you can then start to look at the underlying factors to try and figure out if that outperformance might continue. And some of the numbers will shock you. It always surprises people when I tell them that Otara, a lower socioeconomic area in Auckland, has had some of the fastest house price growth in that city. So these numbers can help you consider areas you might not have thought of before. The third thing I want are suburbs that have okay yields, because while I'm looking for growth properties, I still want it to have an acceptable rental return. And all of this is just to narrow the 45,000 properties you could buy, which is totally unmanageable, down to a hit list of properties that you could actually consider. But there are still two more factors I also care about. The fourth is population growth. Is the city growing? Auckland and Christchurch are. Cities like Nelson, they aren't growing as fast. And no population growth means no extra demand for your property in 10 years' time. And the last thing that I almost always want is a new build. And I know what you might be thinking. Ed, of course, you're going to say that. Your company, Opus, helps investors buy new build properties. But there is a reason we do that. So a few years ago, I wondered if existing properties go up faster than new builds. Most investors assumed they did at the time. So I went to Cotality, paid thousands of dollars and got the data. And as far as I could tell, nobody in New Zealand had actually run these numbers before. And here's what I found. Over the long term, new builds and existing properties grow at roughly the same rate. So if the capital growth is the same, why do I personally invest in new builds? Well, it's because the deposit is lower. It's 20% on a new build versus 30% on an existing property. So I get effectively the same capital growth, but don't have to put in as much money for a new build. Well, that means I could potentially get a higher return on the cash that I put in. Now, the link to the full research is in the cheat sheet, along with videos that go deeper into finding undervalued areas and picking the right suburbs. But this is the framework. 5 things, get them right, and you've narrowed 45,000 properties down to a much smaller list that you can actually manage. The next step is to buy these properties consistently and follow the plan. And the truth is that you're going to spend 20 years in this phase. Figuring out when you can buy your next property, running the analysis to see which property to buy. And I fully get that there's a lot more to consider, which is what the other 1,000 videos on this YouTube channel are about. And if you're enjoying this video, make sure you hit the like button, because that's how I know which videos to create more of. And honestly, it also helps with the YouTube algorithm. Subscribing, that helps too. You guys have already helped us create the largest property investing community in the country, and we are on our way to 50,000 subscribers. And while you're down there, make sure you ring the notification bell. That way you'll hear about these videos as soon as we post them. And if you do already subscribe, you'll know that phase 3 is where the rubber really hits the road. This is where you actually flip the switch from building wealth to living off the wealth. Remember earlier when I said that most investors buy growth properties first? Here's where that pays off, because step 7 is to sell up and buy up. This is the transition where we slowly sell those growth properties and buy yield properties instead, going from building wealth to living off it. And this is the part where most investors get it wrong. In my book, Wealth Plan, I talk about giving yourself 5 years to make this transition. Not 5 months, not one big sale, 5 years, because that way you can choose the right time based on whether the markets are up or down. Now, there are some exceptions to that rule. For example, we had some clients, Tom and Sarah. They earned really good money. They were both working professional jobs. I think Tom was earning 140 grand. Sarah earned $150,000. And they followed the boring blueprint. They owned their own home. They paid it off. They slowly bought 4 investment properties over 12 years. And by their mid-50s, they had 4 investment properties. 1 was fully mortgage free, and they had a paid off home. Then COVID came along, property prices skyrocketed. They looked at each other and said, oh, we actually think it might be the time. So they started selling their properties and ended up buying a commercial property, which is one type of yield property. That now pays them $180,000 a year or $15K a month. So they quit their jobs, retired early, and just started living off the rent. Now that is the boring strategy in action. It's not flashy, it's not fast, but it worked. Now step 8 is once you have your higher yield properties, the work's not done because you still want the freedom to go overseas whenever you want rather than worrying about getting a late night call from the tenants. So step 8 is to automate everything, automate your portfolio. Because look, if you're retired but still spending 10 hours a week chasing tenants, paying invoices, arguing with the council, you're not really retired. You've just got a part-time job that pays poorly. So here's the automation playbook. Get a good property manager. Give them a maintenance threshold, say $500. Anything under that, they can handle without contacting you. Anything over that, they call to get your permission. That way, you stop being the middleman for every leaking tap. Set up your bank accounts properly. So the rent comes in, the automatic transfers go out to the council rates, the body corporate, any insurance that you've got. I do this for my own properties. The money goes out monthly to the council. By the time the council sends me a bill, half the time I'm actually in credit and I don't owe them anything, so I don't even bother opening the letter. And this is the one that most people forget, which is setting up a separate tax account. So when you earn a salary, your boss handles the tax. The accounting department keeps it aside. You never see that tax money, you never think about it. But once you're living off rental income, nobody's doing that for you. You've got to do it yourself. And a few times a year, your accountant will send you your tax bill and tell you how much you need to transfer to the IRD. And if you don't have the money, if you already spent it, the tax man is not very forgiving. So preemptively putting a portion of every rent payment into a separate tax account, that means the money's going to be there when that IRD bill arrives. Now, it's boring? Yes. Does it work? Yes, it also does. And that takes us to step number 9, which is the fun bit, which is you retire and you actually spend your money. This is the part that nobody really talks about. People spend 30 years building a portfolio and then never spend the money. They've trained themselves so well to save and reinvest, and then they find it difficult to spend the money that they actually could. I just think, don't do that. The whole point of going through the 9-step boring blueprint was so you could enjoy your life. And I'll give you the example of Tanya, who I talk about in my book. Now, we met her in 2013. She was 57 at the time. She had 2 teenage sons. And like many Kiwi parents, she had one eye on helping the boys into their first homes, the other one on herself. And she didn't want to rely. She was really clear on this. She didn't want to rely on her kids when she retired. She also didn't want to have to rely on the government just in case the New Zealand super rules changed. So she wanted to retire on the rent from rental properties. She already owned 2 at the time, but they would have only paid her about $24,000 a year if she'd tried to retire at that point, which was not enough for her. So she set a goal. She wanted to retire by 65. She had 8 years to grow the portfolio. So she decided to buy a property in Christchurch. Then she bought an apartment in Wellington. She sat on them for another couple of years. Now, by 65, her portfolio was worth $3.5 million, and over 19 years, she had made over $2 million from her properties going up in value. But she also had a lot of debt on those, right? So then she flipped the switch. She went through this third phase, the payoff phase, the sell up, buy up, the automating a portfolio so she could actually spend it. So she sold 3 standalone houses, the 3 of those houses she had, paid off the debt on the apartment, bought another high-yielding apartment without a mortgage, and today those 2 properties together pay her $79,000 a year. Now, after everything, we add an NZ Super, she's on roughly 106 grand a year for the rest of her life. She used the equity to help both her sons buy their first homes, and she travels when she wants. Look, she's not a gazillionaire. She just picked the right properties, invested long-term, and stayed focused. And that is the boring blueprint in action. And with all of this, boring is a feature. It's not a bug. The enemy, to me, isn't the market. It's not interest rates. It's not the government. It's the urge to try and chase shiny objects when boring is sometimes what works. So if you want to download the blueprint, the QR code's on your screen, the link's down in the description. It's got everything we covered, plus the spreadsheet. And remember, Tanya didn't do anything you can't do. She just stayed boring for 20 years and retired off real estate. And if you liked this video, you have to watch this one about what I'd do if I was starting again from scratch.